In today's dynamic market, understanding the value of assets is paramount. This is where appraisals come into play. Appraisals provide an objective estimate of worth, crucial for various financial and legal transactions. Whether you are buying or selling a property, settling an estate, or seeking financing, an accurate appraisal is essential. It protects your financial interests and ensures fair market value. Appraisals offer peace of mind by providing a clear understanding of an asset's worth. Accurate valuations are the bedrock of informed decision-making. For sellers, appraisals help determine a realistic asking price, attracting potential buyers. Buyers benefit from knowing they are paying a fair price for their investment. Lenders rely on appraisals to assess risk and determine loan amounts. In essence, appraisals bring transparency and trust to financial transactions. They provide a reliable basis for negotiations, reducing disputes, and ensuring a smoother process for all parties involved. Moreover, appraisals play a vital role in resolving legal disputes, such as divorce settlements or estate divisions. They provide an unbiased assessment of an asset's value, facilitating fair and equitable resolutions. In an ever-evolving market, staying informed about the importance of appraisals is crucial for anyone involved in buying, selling, or managing assets. Understanding their significance empowers individuals and businesses to make sound financial decisions and navigate the complexities of the marketplace. In the following sections, we will delve deeper into the world of appraisals, exploring the different types, methods, and their relevance in various contexts. Appraisals are essentially professional assessments that determine the market value of an asset. This asset can be tangible, like a house or a vintage car, or intangible, like a business or intellectual property. Appraisals are conducted by qualified professionals who adhere to specific guidelines and ethical standards. They utilize their expertise, market knowledge, and various valuation methods to provide an unbiased and well-supported opinion of value. The scope of appraisals extends far beyond real estate, encompassing diverse areas such as personal property and collectibles. In real estate, appraisals are essential for buying, selling, refinancing, or property tax assessment. For personal property like jewelry, art, or antiques, appraisals are crucial for insurance purposes, estate planning, or equitable distribution in a divorce. Collectors rely on appraisals to determine the authenticity and value of their prized possessions. The appraisal process typically involves a thorough examination of the asset, considering factors such as its condition, location, market trends, and comparable sales. Appraisers gather relevant data, conduct analyses, and prepare a detailed report outlining their findings and the rationale behind their valuation. This report serves as a valuable document for various stakeholders, providing transparency and supporting decision-making. Understanding the purpose and applications of appraisals is fundamental for anyone dealing with valuable assets. Whether you are a homeowner, an art enthusiast, or a business owner, recognizing the importance of professional valuations can safeguard your interests and ensure fair dealings in any transaction. The market comparison approach, often referred to as the sales comparison approach, is a cornerstone of appraisal methodology. As the name suggests, this approach hinges on comparing the subject property, the one being appraised, to recently sold comparable properties, or comps. The underlying principle is that similar properties in close proximity should have similar market values. The process begins by identifying recent sales of comparable properties. This involves considering factors such as property type, size, location, condition, and amenities. Appraisers meticulously analyze market data to find the most relevant comps. Adjustments are then made to the sale prices of the comps to account for any differences between them and the subject property. These adjustments reflect the market's perception of value regarding specific features or conditions. For example, if the subject property has a larger lot size than a comparable property, an upward adjustment is made to the comp's sale price to reflect the added value. Conversely, if the subject property requires repairs that a comparable property did not, a downward adjustment is made. The adjusted sale prices of the comps provide a range of values that indicate the likely market value of the subject property. The market comparison approach is particularly well suited for residential properties where there is ample market data available. It is a reliable method when there are recent sales of similar properties, providing a direct and intuitive way to determine value based on actual market transactions. Section 4. Building value. Deconstructing the cost approach. The cost approach to appraisal is rooted in the principle of substitution. It posits that a buyer wouldn't pay more for a property than it would cost to build a new, comparable one. This approach is particularly useful when appraising unique properties, new constructions, or properties with limited comparable sales data. The process begins by estimating the current cost of constructing a replica of the subject property, considering current material and labor costs. This estimate is then depreciated to account for physical deterioration, functional obsolescence, and external factors that may have diminished the property's value over time. For instance, if the subject property has an outdated kitchen, the cost of remodeling the kitchen would be factored into the depreciation. After accounting for depreciation, the depreciated cost of the improvements is added to the estimated land value to arrive at the final appraised value. The cost approach is particularly relevant for specialized properties such as churches, schools, or hospitals, where comparable sales are scarce. It is also useful in assessing new construction projects, providing a realistic estimate of the project's value upon completion. Section 5. Income as a measure. Understanding the income approach. The income approach, also known as the income capitalization approach, is particularly suited for income-producing properties, such as apartment buildings, office buildings, or retail spaces. This approach determines value based on the property's potential to generate income. The underlying principle is that an investor would purchase a property based on its anticipated future income stream. The process begins by estimating the property's potential gross income, considering factors such as rental rates, occupancy rates, and other sources of income. Operating expenses, such as property taxes, insurance, maintenance, and management fees are then deducted to arrive at the net operating income, or NOI. The NOI is then capitalized, which means converting the income stream into a lump sum value. This involves dividing the NOI by a capitalization rate, which reflects the expected rate of return for similar properties in the market. The capitalization rate considers factors such as risk, interest rates, and market conditions. The income approach is a valuable tool for investors looking to assess the profitability and potential return on investment of income-producing properties. It provides a clear understanding of the relationship between income generation and property value.